The market doesn't care what earnings are, it cares whether they're better or worse than expected. That gap between expectation and reality is where money is made and lost, sometimes in seconds. Most investors wait for the number to drop. Smarter investors do the work before. Today I'm showing you how to use AI to size up any company before earnings, so you know the setup, the risk, and exactly what to watch for. Welcome to the AI portfolio. I'm showing everyday investors how to use AI tools like Chat, GPT, and Claude to research smarter and make better decisions. Quick disclaimer, this channel is for educational purposes only. Nothing here is financial advice. I'm not a financial advisor, and you should always do your own research before making any investment decisions. Now let's get into it. Earnings season is the most volatile time in any stock's calendar. A company can grow revenue 20% and still drop 15% on earnings day because analysts expected 25%. The price reaction isn't about the absolute number, it's about the surprise. Beat expectations and you get rewarded. Miss them, even slightly, and the market punishes fast. That's why the setup matters as much as the result. Before earnings, you want to understand, what is the market expecting? How has this company historically performed against those expectations? And are there any signals that this quarter could go differently? That's exactly what we're going to build with AI. Before any earnings call, there are 5 things worth understanding. First, the historical beat and miss pattern. Has this company consistently beaten estimates, or does it regularly disappoint? Second, estimate revisions. Have analysts been raising or cutting their numbers in the weeks leading up to earnings? Revisions tell you where sentiment is heading. Third, guidance track record. Does management guide conservatively and over-deliver, or do they tend to overpromise? Fourth, the whisper number. The official estimate is public. The whisper number is what the smart money actually expects, often higher. Fifth, sector and macro context. Is the broader environment working for or against this company right now? The first prompt builds your historical baseline. Here's how to run it. Paste this into ChatGPT or Claude. Analyze the last 8 quarters of earnings for company name. For each quarter, show the EPS estimate, the actual EPS, the beat or miss percentage, and the stock's one-day price reaction. Then identify any patterns. Does this company tend to beat, miss, guide conservatively, or surprise in a particular direction? This gives you the company's earnings personality. Some companies beat every quarter by a few cents. Others miss regularly and sell off hard. Knowing the pattern is the foundation for everything else. The second prompt focuses on what analysts have been doing to their numbers recently, because revision direction is a powerful signal. Use this prompt. For company names, upcoming earnings, summarize how analyst EPS and revenue estimates have changed over the past 30 and 90 days. Are estimates trending up or down? What has management guided for most recently? And how does that guidance compare to the current consensus? Flag any meaningful divergence between what management is saying and what analysts are modeling. Rising estimates mean expectations are building. Falling estimates may mean the bar is being lowered, which can actually set up a beat if the company delivers anything decent. The third prompt looks at catalysts and risks. What could push this quarter's result above or below expectations in ways the model doesn't capture? Prompt: before company names upcoming earnings, identify the key factors that could cause a beat or miss versus current consensus. Consider recent competitor results in the same sector, any macro or currency headwinds relevant to their business, supply chain, or cost pressures, recent news about demand trends, and any company-specific events in the last 90 days. Give me a balanced view of upside and downside scenarios. This turns AI into a pre-earnings research analyst, surfacing risks you might miss reading just the headline estimates. Here's how to run this as a complete system. Start 3 to 5 days before earnings. Run prompt 1 to map the historical pattern. Run prompt 2 to understand where estimates sit and which direction they've been moving. Run prompt 3 to identify the macro and company-specific factors that could cause a surprise. Then ask yourself 2 questions. What is priced in, and what would it take to surprise? If expectations are high and every risk is known, even a solid beat might produce a muted reaction. If expectations are low and sentiment is negative, a modest beat could spark a real move. The edge isn't predicting the number, it's understanding the setup. A few mistakes to avoid when doing earnings previews. Don't confuse a beat with a buy signal. If a stock is priced for perfection, beating by 2 cents isn't enough. Context matters. Don't ignore guidance. The market often cares more about what management says about next quarter than what just happened. A strong quarter paired with weak guidance is usually a sell. Don't skip the sector check. If every company in the industry is missing, yours probably will too. Peer results are often a leading indicator, and don't trade earnings without understanding the implied move. The options market prices in an expected range. If you're surprised by a 10% swing, you didn't do the setup. Here's your homework. Find a company in your portfolio or watch list with earnings coming up in the next 2 weeks. Run all 3 prompts. Build the full picture before the number drops. Historical pattern, estimate revisions, and the risk scan. Then watch what happens. Notice whether your prep changes how you interpret the result when it comes in. That's the skill you're building. Not predicting the number, but understanding the setup well enough to react clearly instead of emotionally. If this was useful, subscribe for a new episode every Monday and Thursday. See you next time.